All right, welcome everybody. It is week number 5, meeting number 5 of the YFP Fellowship. We are going to be talking about investments and retirement today. Before we dive in, I want to do a brief overview of kind of what the schedule is going to look like going forward. And then if anybody has any follow-up questions from our last meeting, which was on student loans, I'd love to discuss that. So let me go ahead and share my screen with you. Can everybody see that? Yep, I got some head nods, we're good. All right. So, all right, so we started June 1st. We did the overview and expectations. July 13th, we did get organized. July 27th, scripture plan. August 3rd, student loan analysis. Today, August 17th, we're going to do investments and retirements. And then starting next week, the 31st, we're going to do the next topic. So does anybody have any big ideas that they want to throw out now? And then we'll talk about it again on what kind of conversations we want to have going forward. Anybody want to throw an opinion out there? Otherwise, we'll just catch it at the end. No? All right. Sharing is always really strong at the beginning of the meetings. Does anybody have any big questions from last week? Or has anybody seen anything in the news, maybe about Donald Trump signing some executive orders that they want to ask questions about? No, nobody's got questions about that. All right, well, I'll talk about it anyway. So after our last meeting, President Trump actually went through and signed some executive orders that will have some impact on y'all for student loans. So we had talked about how most of you are in a grace period right now, so you're not making payments until the end of the year. Some of you are going to start making payments earlier by consolidating your loans and jumping on that bandwagon faster. For those who do, the CARES Act that came out in March gave 0% interest and $0 payments until the end of September. President Trump actually signed an executive order that extends these 0% interest, $0 payments through the end of this year, 2020. But his extension does not include any kind of protections for those looking for PSLF. So as it currently stands, if your intentions are to consolidate and you are trying to do public service loan forgiveness, as of today, you're going to start making payments in October. Does that make sense to anybody here? Does it not make sense to anybody?
I have a question.
Yeah.
If somebody is interested in loan forgiveness, does the residency or fellowship count towards the years of service if you're serving the government?
Yeah, if you work for a nonprofit, then as long as you're working for them full-time, it counts. So residency would still count, but only once you start making payments. So if you're currently in a grace period, this time doesn't count. Once you're out of your grace period, then your payments will start counting towards PSLF. That's actually a great time to do it.
Thank you.
Cool. Anybody else got a question before we start? Related, unrelated, speak now, forever hold your peace until the end.
I have a quick question.
Yeah.
The loan forgiveness change does not apply to the folks who are pursuing forgiveness that are not public, the non-public health.
Correct.
Does it? Okay.
Correct. As far as we know, we're gonna hear some more. There's gonna be some more news to come out of this before the end of September, and we'll talk about it whenever it does. But as of today, it does not. Cool. All right. Well then, let's talk a bit about investments and retirement today. So today's going to be extremely educational. So I'm going to be talking about a whole bunch of data as we go through this. I kind of just want to give like a foundational level of information so everybody can really get an understanding of what we're talking about when we say investments and kind of how they impact you. So if you have questions along the way, please feel free to reach out. But we're going to be moving through a lot today, so I'm going to try to go kind of quick. So we're going to answer all this stuff that's here. So let's talk about money. All right, so kind of what is investment planning? So as we're talking about investment planning, it's really like the key element in achieving your financial goals. So what we mean that is your money is getting weighed down, right? So every day that goes by, every month that passes, every year that passes, you have to pay more in taxes, and the value of your money goes down thanks to inflation, right? So we want to combat that with some of the good things from investment management, which is things like capital appreciation, which we'll talk about, which is how things go up in value over time, dividends, which is profits coming from a company, and income interest from bonds, which is a type of fixed income, which we'll talk about later. So it's difficult to achieve your financial goals without the ability to invest and grow. So without getting those good returns, it's hard to overcome the bad returns. So we'll talk about the $10 latte. So the $10 latte is just kind of like, hey, you know, if you went to Starbucks today and you bought a latte in 2020, it probably cost you about $4. 30 years from now, that latte is going to cost you $10, right? You've probably heard your parents or grandparents saying, oh, well, when I was younger, this used to cost $1. Or when I was younger, this used to be all fields and you could buy a house for 20 grand, something like that. That's just inflation. That's how inflation works. Things just become more and more expensive over time. So we have to protect against that by investing. So let's talk about how we can save. So if you were saving, right, because you're all going to be wonderful savers, if we were saving without investing, what would that look like? So let's take conservative Jane here. So conservative Jane, she makes $120,000 a year. Congratulations, she's a great pharmacist. We're going to give her 3% cost of living adjustments. So COLA is cost of living adjustments over time. We're going to say she's going to invest 10% into her retirement plan through work, and she's going to work for 30 years. That's a great thing to look for, right? So if we did that, and without investing, so we have 0% return, from 2020 until 2050 for 30 years, she's going to be able to save $600,000, which sounds like a whole bunch, but it's really not, right? So we always try to find people who are smarter than us because it's not that hard to find them, and use quotes from them. So compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. What that basically says is if you're using your money strong, then you can use the power of compound interest. If you're using your money poorly and you have a lot of debt, then you're going to be eating that compound interest, right? So you want to take advantage of it. So let's compare this to aggressive Jan. So same person, $120,000 of income, 3% cost of living adjustment, 10% contribution to retirement plan, 30-year career, everything exactly the same. The only difference is we're gonna assume a 7% return instead of 0. So instead of $600,000, we're able to save $1.8 million. So the same exact person doing the same thing except for investing. Now, when I say this is 7% return, I'm going to explain why I'm using 7%. Just a few seconds. If you're not wondering why I use 7%, you should start questioning when someone's trying to sell you something and they start throwing out random numbers. You should always ask where the numbers come from and what they mean. So let's talk about a little bit about history. Everybody good so far? All right, so we all understand inflation. Good. So there have been 12 economic recessions since World War II. Right, so the stock market as a whole, before I get there, does anybody know what S&P 500 is? Who wants to tell me what it is? Austin's got a good head shake. Austin, what's the S&P 500?
To put it vaguely,
Yep.
Just a combination of the top 500 companies, publicly traded. Is that what you're looking for?
Yep, that's dead on. So we're going to talk about a couple different rating companies as we go through today. And the first one is S&P, also called Standards and Poor's. So the Standards and Poor's 500 are the 500 largest companies publicly traded in the US. All right. When people talk about the market is up or the market is down, this is generally what they're talking to. They're talking about the S&P 500. So they're saying, oh, the market's up 5 points today. They're either talking about the S&P 500 or they're talking about the Dow, also called the Dow Jones Industrial Average, which is like 30 large companies. Okay. So when we talk about going forward, when we talk about the market, I'm going to refer to the market as the S&P 500. Okay. So if we look at this chart, so this chart goes from 1928 until 2014. We got all these ups and downs, right? So we have 12 significant economic recessions in this time frame. But I don't care about the small ups and downs. I want you to see this positive slope, right? So as we can see, over time, the stock market goes up on average, right? So that average that it's going up over year is 10%. Once we adjust for inflation, right? So inflation, things get devalued every year. As we adjust for inflation, it takes that 10% and it means it's really like 7%. So that's where I'm using that 7% return from. So we take this huge positive slope, we take out the inflation, it's about 7%. I'm going to show this a couple different times just to make sure everybody's tracking. All right, so this is that same S&P 500. This is a larger time frame. So this is 1872 until 2018. This is every single year, every 1 year of the stock market return. So we've had highs way up here in the 50s. We've had lows down here in the negative 37, I think was what this was. On average, adjusted for inflation, on average, we're right around that 7% time. Okay. So when we start making projections, we're going to say 7% because that's the historical average of the S&P 500. Everybody on cool with that? I got some good nods. All right. So we're also going to talk about using our money, right? So when we're talking about investing, we got to know, like, what do we mean on, should we only care about single years? Should I care about bulk years, right? So this is a range of real returns annualized, meaning the average broken down by years. So in any 1 year, let's say I'm investing in the stock market and I have 1 year before I need that money back. Any 1 year, I could have a return as high as positive 53% or a return as low as negative 37%. That's a pretty fucking wide margin. So if I need my money next year, I don't know that I want to do that because I don't want to lose 37% of my money within this next year. That's pretty scary. So maybe 1 year, we're not going to put things in the stock market. Okay, what about any 5-year time frame? So 2000 to 2005, 2001 to 2006, any 5-year rolling time period, we could have a high of 28.5% and a low of negative 11.7. That average still around 7%. Okay, now that's not great still. Maybe we still want to be a little cautious rather than investing. Okay, we get a little farther out. Any 10-year rolling time period, positive 17.6, minimum negative 4. Okay, our numbers are starting to get a little closer together. We're still around that 7%. Over 20 years, so 2000, 2020, 1999, and 2019. We've never in the US, for the S&P 500, had a 20-year time frame where the S&P 500 was down. We got really close one time, but we've never had to go down. So that makes me say, if I'm looking back at this positive slope, if I'm investing for the long term, like retirement for most of you, I'm okay being fully invested in the stock market because in the long run, I'm going to come out ahead. I don't care about these little dips. You know, if I'm retiring at 60, I don't care about this dip at 37. I don't care about this dip at 40. I only care about what it looks like when I'm 60. Does that make sense? All right. But I am worried, like, we got this recovery time frame. So if we need some money, right? So let's think back to 2008, 2009. So when the stock market crashed, some of you were in junior high. Some of you were in high school. Some of you were in college already, all over the place, right? So market hit a peak here in 2000, like March, October timeframe, 2007. And then it dipped. And it took about 15 months for it to go from the top to the bottom. We didn't know where we were in the top. We didn't know we were at the bottom. That's not how you work. You can only see it in hindsight. It took about 15 months. And then it took another 2 years to climb out of that. So when we start thinking about the stock market, it could take up to 3 years to go from peak to peak if we're thinking about the stock market, right? So this just reminds us that we want to make sure that we're not investing money that we need within the next 3 years because it may take that long to get it back. Does that make sense? All right, cool. So let's talk about investment variables. So when we're talking about investments, we want to know all the kind of variables that go into choosing the right kind of investment or the right type of investment tool, okay? So the first one I've just been talking about is time horizon. How long until I need that money? Do I need that money right now? Do I need that money next week? Do I need money next year? Do I need that money next decade? What's my time horizon? Diversification is how you spread out your risk over multiple investments. The best thing I like to do for this is if I was shipping goods from Spain to London and I was sailing goods over there, do I want to put all my stuff onto one ship or do I want to spread it across 10 ships? So if one ship sinks, do I lose everything or only lose 1/10? So that's diversification. So it spreads out the risk. So instead of putting all your money in Bitcoin, like people tried to do 2018, let's spread it out. Let's get some Dogecoin in there. Let's get some Ethereum in there. Let's do all that. Diversification. Tax advantage. Some investments and some investment vehicles, which we'll talk about, have advantages when it comes to your taxes, right? Maybe they're exempt, meaning you don't pay any taxes. Maybe they're deferred, meaning you pay taxes later. Maybe you get tax deductions. Maybe you get tax credits, right? We want to take all that into account. The rate of return is what you expect to profit from an investment. I expect this rate of return to be 4%. Right now, Ally Investments is the tool we use for banking. Their rate of return is 0.8%. That's pretty low. Liquidity is how easy it is to access your money without taking up substantial loss. So liquidity would be the cash in your pocket, super liquid, right? I can use it right away. The cash in your bank account, pretty liquid. I can get to that. The cash in your couch. Allison, if you had to sell your couch right now, you'd probably have to take a loss, so that'd be pretty hard to get. The cash, the value of your home or your car, probably worse, right? So illiquid. Some investment tools are less liquid than others. Some investment tools are very liquid, meaning you can sell them at any time for an expected return of what they're worth. And then risk. Risk is kind of a tricky one because it's defined differently by different people, but risk is the uncertainty involved in an investment's actual returns, right? So I expect to get this return, but the risk is like the uncertainty of if I'm actually going to receive that. Company could go bankrupt. Company's product could not sell as well as everyone expected. A country that I'm borrowing money to or I'm lending money to could just go to war and completely disappear, never get that back. People had bonds for Puerto Rico and they got hit by a hurricane, they can never pay that stuff back. That's the risk that you don't know. So when we calculate risk, I'm sure you've all seen these charts before. When we calculate risk, we're going to do it a couple different ways. We're going to talk about market risk, also non-diversifiable risk, and we'll talk about non-market risk, which is diversifiable. So market risk are things that I can't control, right? So they're inherent to investing. Can't be eliminated. This is purchasing power. This is exchange rate. This is any number of things, right? So they're just going to happen. But there's also non-market risk, meaning things that I can change myself. So if I'm worried about, I don't know, Elon Musk going completely crazy and Tesla just like blowing up as a company, I could diversify away from Tesla and other Elon Musk companies. If I'm worried that, I don't know, we're going to go to war with China or something and we're going to have all these tariffs and everything, I can diversify away from Chinese companies or companies that do mostly business with Chinese companies. So there's some risk I can get away from. The way we measure risk, and this is not important for you guys to remember, I just want you to hear it one time before you're somewhere else and someone's trying to sell you something and they start using all these fancy words and you'll be like, that sounds kind of like bullshit. I know what that means. So we'll talk about beta and standard deviation, right? So beta is kind of just how to measure volatility relative to the stock market, right? So a beta of 1 would mean if the stock market's up 10, I'm up 10. Stock market's down 10, I'm down 10. A beta of 1.25 would mean if the stock market's up 10, I'm up 12.5. But if the stock market's down 10, I'm down 12.5. Does that make sense? A beta of less than 1 would mean you just don't move as much. So a beta of 0.8 would be if the stock market's up 10, I'm up 8. If it's down 10, I'm only down 8. So it's less downside also to go with that. And then standard deviation. So earlier I talked about my rate of return. If I have an expected return of 10% and I have a standard deviation of 6, just following pure bell curve here, 68% of the time I'm going to have a return between 4 and 16. 95% of the time I'm going to have a return between -2 and +22, and so on and so forth. Does that make sense? All right, you're never going to have to think about that again. Any questions so far? Anybody bored and want to sign off yet? I'll do my best to keep you all here. Right now we have how many people? I'm going to see if anybody leaves. All right, so when we talk about investments, you also want to try to stress test things, right? So you want to know how your investments would have done in a downtime, right? We've had all these bubbles we're talking about. We've had all these recessions. Like, what does my return look like? So here I'm going to start showing some stuff. So YFP, Your Financial Pharmacist, we create our own portfolios here. And I'm going to show you these sets. So this right here, a YFP 100-0. What this means is 100% invested in the stock market, 0% invested in fixed income. And I'll explain what those mean in a minute. 80-20 would be the same thing. So 80% in the stock market, 20% fixed income, 60-40, 40-60. Does that all make sense? All right. If we look back at different crises, right? So we got the World Trade Center, we got subprime mortgage crisis, we got coronavirus. How would each of these portfolios done in those markets? So if we just go back to coronavirus, so this is the beginning of this year. If you were 100% invested in the stock market, at the depths of the coronavirus pandemic, according to the stock market at least, your portfolio would have been down 37%, which is pretty scary. So a bunch of people lost a whole bunch of money at the beginning of this year. But even if you were only 40% invested, you'd still be down about 15%. So there's no way to completely get away from it. If you want the upside, you got to take some of the downside, right? If we're looking long-term, so this is a 20-year time frame, right? So this is 2000, 2020. If we all start at zero, that 100-0 portfolio I talked about is on the top, that 40-60 is at the bottom. So when you're up, and when you're down, you're down. You got to understand what those curves look like. So when the market's going good, you're riding that good run. When the market's running bad, you're hibernating with the bears. So this is something you always want to be cautious of. When we're talking about investments, how risky are we in the stock market? Are we okay taking these big swings because we have a long time horizon? Or do we need to be a little more cautious, accept a lower rate of return to decrease our risk? Does that make sense? All right. Any questions so far? Nothing, okay. All right, let's talk about different types of investments. So we're talking about types of investments. The most common types of accounts, we have accounts that are managed by your employer, and we have accounts that you manage on your own or with the help of an advisor. So accounts managed by employer. So this is your 401ks, your 403bs, your 457s, your TSPs, right? All that kind of stuff. These are the most popular kind of setups. So the employer can create a plan for you. It's as a way to share profits and share investment returns. There's have to be sponsored by the employer. You can participate by electively taking deferrals out of your salary. So it comes straight out of your paycheck. You can put up to $19,500 per year into those accounts. I doubt any of you will be doing that much this early, but eventually that may be something you want to shoot for. Some of the advantages, it gives you a bucket to defer to retirement. It's typically the best vehicle if you're doing student loans. So when you put money into these accounts, they can either be traditional or they can be Roth, which we'll talk about in a minute. How you choose those accounts is going to change some things, right? So traditional would mean it goes in tax deductible. So you get to decrease your income today and you pay taxes later. Does that make sense? If you decrease your income today, that means your student loan payments are going to be lower because we're calculating based off of income, right? So this change can also affect student loans. It allows for your employee, yourself, to have some options, but not so many options. So there's generally going to be like a menu item. So there's a list of investments you can choose from, and then you can only choose from those investments. They also allow in-service withdrawals if you have financial hardship, which I never recommend, and they allow loans, but I never recommend those either. Some of the disadvantages, the employer doesn't have to give you anything. So actually during this coronavirus, a lot of companies are ending their match, meaning they're not going to give you any bonus or not any addition to that plan. There's no guarantee for return. They're just investments into the stock market. Sometimes the investment selection is really shitty. For the most part, that's not the case, but if you're in a smaller company, that may be the problem. And then sometimes there's a lot of fees that we can't see. So they're very opaque, meaning they hide things in there which we don't like. Does that all make sense? Most, if not all of you, will probably have access to a 401k, 403b, 457, or TSP within, if not already, or within the first couple of years of your career. And then those will be around for a long time. And you also have managed accounts for yourself, right? So you can have a traditional IRA, a Roth IRA, an HSA, also called a health savings account, or an individual brokerage account. It could be just for you, or it could be joint between you and somebody else. So let's talk about those. So a traditional IRA. So a traditional IRA is a way to like supplement your other accounts. So you can supplement your 401k. So IRA just stands for individual retirement account or individual retirement agreement, depending on who you talk to. So it's a tax vehicle with tax advantages. So just like the 401k, it can decrease your income now because your tax deductible. When it's investing, it grows tax deferred. And then when you take it out, it's taxed as income. Does that make sense? Goes in deductible, grows deferred, comes out as taxable income. Unlike a 401k, there's no sandbox. I can invest in whatever I want. So I can choose any kind of investments I like. Contributions, I used to be able to do 19,500 up here. Down here, I can only do 6,000. So a lot lower contribution limit. They're appropriate to use if you're trying to shelter things, if you have a desire to defer taxes, if you desire long-term accumulation. So some of the advantages, investment income earned is not subject to federal taxes. So again, they grow deferred. Some of the disadvantages, if you try to take it out before age 59 and a half, you have to pay taxes and a penalty. So we're talking about earlier, we said those tax advantages that we could use for investments. This one has one, but it also has a penalty if you don't use it correctly. So you can't use your retirement savings to pay for a boat, right? You got to use other tools for that. Also, if you're saving in this retirement account, at a certain point, you've never paid taxes on it. The government says, I want some taxes. So by age 72, they're going to say you have to start taking money out. Those are called required minimum distributions, also called RMDs. All right, there's also a Roth IRA. So a Roth IRA, very similar to traditional IRA. It's for retirement accounts. The main difference is the tax treatment. So with the traditional IRA, it goes in tax deductible, grows tax deferred, comes out as taxable income. With a Roth IRA, it goes in after taxes, meaning I pay taxes on it, and then the money goes in. It grows tax deferred, and it comes out tax free. So I don't pay any more taxes. So in this one, I don't pay taxes until the end. In this one, I pay taxes up front. I never pay taxes again. Does that make sense? Most of the other things are the same, right? So they both have a $6,000 contribution limit, and it's $6,000 total. So it's not 6 plus 6, it's 6 between the two. They also have income and limitations. So if I make too much money, I may not qualify for some of these. All right, if I have access to other plans, I may not qualify for some of these. We can talk about that specifically if anybody has any questions. Again, you can also contribute to any kind of tool. Emily, you got a question?
Yeah, I was actually like piggybacking on your 6 plus 6 kind of iteration. I guess my thought on that was, can't you have multiple traditional IRA accounts that you could make $6,000 contribution to each? I just am confused about like, is it only $6,000 for the
you get one $6,000 per year. If you opened up a whole bunch of IRA accounts and you started making 6,000 contributions to all of them, the IRS would come down on you and make you pay taxes and a penalty for all of that.
Okay, and it's the same in terms of the 401k or 403b. Say you had multiple jobs.
Yeah, so it's $19,500 per year amongst them all. Now there's some gray area in there. So if you have a 457, so some of you are going to work for like government or cities or anything like that, and you're going to have access to multiple of these accounts. You may have access to a 401k or a 403b or a 457. 401k, 403b both have a limit of $19,500 total that you contribute. 457, you can do an additional $19,500, so it's separate.
Oh.
So most of you are not going to need to put that much money away for retirement because you can't access it until 59 and a half. But some of you later in life may want to kind of super fund your accounts, meaning you could add a whole bunch, and that's a way to do it. But to answer your question, all of this, $19,500 per year, both of these total $6,000 per year if you qualify for them. A lot of you are going to be earning too much once you get your big jobs. You're going to be earning too much to qualify for traditional IRAs if you have access to a 401k. And then some of you, maybe it's through a spouse or maybe it's just balling out, are going to make too much money to qualify for Roth IRAs as well. Does that make sense?
Yeah, thanks for clarifying.
Austin, what do you got?
You'll probably get to it, but just to make sure. So it's not 19,500 with the 401 and the 403 plus the 6,000. So like 25 total, or is that right?
Yeah, you can do that if all the numbers work. If you qualify for everything. So if you have a 401k, you don't qualify for a traditional IRA.
Oh, so you can't qualify for everything.
You can't qualify for everything.
Okay.
You can kind of qualify if you have and you make less than like $70,000, you can qualify for everything, but then you're not going to have enough money to invest in everything. So it's kind of like a tricky thing there. But yeah, you could put 19,500 into this, and you could put 6,000 into this, and we have clients that do that if they're making just the right amount of money. That's a lot of money to put away towards retirement, though, especially at a young age. You probably have other things you could attack more aggressively. Yeah. All right. Roth IRA, again, real similar, traditional. You can invest in whatever you want. You're still subject to those penalties if you try to take it out early, but you are able to take out your initial deposits without any penalties, right? So you already paid taxes on your deposit, so you're able to pull that back out without any kind of penalties. And there are some other tricks in here if you ever want to work with a tax attorney. If you needed to take money out for a first-time home purchase, you can kind of get money from these. There's some loopholes to get access to cash. All right, HSAs, so a health savings account. Some people also call this a stealth IRA. So an HSA is designed if you have a high deductible health savings plan, then you have access to an HSA. So it's there to allow you to save money for when you need those medical expenses since you're paying a high deductible. But if you wanted to, you could actually save this towards retirement and you could use it as an additional form of IRA. Some people will do that, and you're able to save $3,550 as an individual or $7,100 per year as a family. But you have to have access to a high deductible plan through work. You can't just do this on your own. The benefit here would be it's what we call triple tax advantaged. So the money can go in tax deductible. It can grow tax deferred, very similar to these three accounts. But as long as you use it appropriately, which means for health expenses, or if you wait till age 65, it comes out tax-free as well. So it goes in tax deferred, meaning no taxes, or tax deductible. It grows tax deferred, meaning no taxes, and it can come out tax-free, meaning no taxes. So triple tax advantaged if used correctly. Really, really fancy account. Again, we're going to get to this later. We'll kind of talk about what order to put them in, I think, in the next slide. And then we have an individual brokerage account. So an individual brokerage account is just where you invest money for everything else, right? So not for retirement or for above and beyond these retirement accounts. Let's say you wanted to save for a house that you're going to buy 5-10 years from now. A brokerage account is where you put it. You just go to the investment bank, you open an account at like Vanguard or Betterment or whatever. You put money in, you buy stocks with it. If anybody is here using Robinhood or anything like that, those are just taxable brokerage accounts. Does that make sense? Any questions about the different types of accounts here? Got some nods. I got some screens moving to make it look like you're saying yes, but it's really just your screen moving.
Is there anything bad about an HSA?
Is there anything bad about an HSA? Not really. HSAs are pretty dope. The only thing about an HSA that may be bad is it just requires you to have a high deductible plan. So for some people, it may be more effective, cost effective to not have a high deductible plan. So if you're going to be at the doctor a lot and you don't want to blow through that deductible, then maybe it makes sense to just have a higher cost plan. For most young families, people, especially if they're expecting to add new members of the family through whatever form they want to do that, I generally recommend to have a lower deductible plan so you have less out of pocket going into that. So you have a higher premium, but you have a lower deductible, and then you wouldn't qualify for an HSA anyway. The HSA is designed specifically to pay those deductibles when you need it, but you can actually save it for a lot longer. So let's say you have an HSA and you have money in it, but you don't want to use it. You just pay out of your pocket for expense. You can actually save that expense, and then you can cash it in later on in time when you need some cash without that. But for the most part, if you're using it what it's for, all these accounts are great. It's just when you try to use an account, you try to get too fancy. You try to use it for something it's not designed for. I like to stick by the KISS method. Just keep it super simple or keep it simple stupid, whichever one you prefer. And then go from there. But all these accounts are pretty good. It's a good question though. I'll touch on this briefly. You may also hear things like a backdoor Roth that people will talk about. So earlier, Austin, you asked, you can't qualify for all these things. That's true, right? So if you make more than, I'm going to make up a number. I don't have it in my head. I want to say it's like $140,000 as an individual. So when you start to earn a lot and you earn more than $140,000, you won't qualify for this Roth account anymore. So people will do what's called a backdoor Roth. It's going to be super confusing. So if you don't want to hear about it, just close your ears for like 20 seconds. If you don't qualify for a traditional IRA, you can still contribute to a traditional IRA. You just don't get the tax benefits. So you don't get the tax deduction in year one. So you do what's called a non-deductible contribution. And then you can turn that into a Roth. So you can do effectively a Roth without having access to a Roth and then convert it into a Roth. So backdoors are super tricky, but they can be very beneficial for people who want access to a Roth account. If anybody cares about that, please ask me later and I will explain it better. All right. So when we're talking about retirement specifically, so when we're investing for retirement, this is kind of the order of operations that we want to do. So let's say we had infinity dollars to put towards retirement. This is where we want to go. So we want to go into the employer-sponsored plan until we get the match. So whatever the match is. So your employer may say, hey, we match dollar for dollar up to the first 3%. So if you put in 4%, they put in 3. Other employers may say, we put in dollar for dollar up to the first 3% and then 50 cents on the dollar for the next 2%. Meaning if you put in 5, they put in 4. Some just give you a flat 7%. It's all across the board. So whatever your employer does, we want to get at least a match if we can afford to, right? It's free money. Once we get the match, then we want to check that plan out and see, hey, are there a bunch of fees here? If there's a bunch of fees, I don't want to pay those. So I'd rather put the money in an HSA or IRA where I can control the amount of fees. If I still have money, let's go back into the employer's plan. Let's max out that $19,500. And if I still have money for retirement, then we'll put it in a taxable account. Does that make sense? Basically, what's the most cost-effective way to do this? So how does the money go in? So if we have a traditional 401k, it goes in pre-tax, so it's tax deductible. We have a Roth IRA. There's also Roth 401ks that you may have access to. Those go in after tax. Traditional IRAs, pre-tax. Taxable accounts are after tax. HSAs are magical. They're triple tax advantaged if we do it right. So it goes pre-tax. So let's say we had $1 million in each of these accounts. You will not have $1 million in each of these accounts, but you will likely have more than $1 million in one or more of these accounts by the time you're done. Way more than likely. But because of the tax treatment, we have to figure it out. So if we had a 401k with $1 million, we never paid taxes on it. So we have to pay taxes on the way out. So my $1 million is really like $750. If I had $1 million in a Roth IRA or a Roth 401k, I already paid taxes, so there's no taxes on the way out. That's still $1 million. Traditional IRA, never paid taxes, got to pay taxes now. Taxable account, I pay taxes along the way. So if I had $1 million in there, I already paid it. HSAs, super magical beast, never pay taxes if you use it right. If it was $1 million before, it's still $1 million now. That make basic sense?
I have a question though. The taxes that you pay, are those dependent on the market at the time or the market at which you started the account?
Yeah, that's a great question. So you're talking about capital gains. So we'll talk about this when we get to taxes at some point, but I'll cover it now because it's perfect timing. So let's say you bought $100,000 worth of Apple stock. And your Apple stock just kept rising and kept rising and kept rising, and now it's $1 million. You pay taxes based on the difference when you sell it. So if you bought it for $100,000 and you sold it for $1 million, I pay taxes on that $900,000. If you bought it for $100,000 and you sell it for $50,000, you get a tax credit. Basically, you can use those credits a little bit every year. So it depends on when you bought it and when you sell it. That's what matters there. So when you buy something, that's called your cost basis. So what's the base cost that I have? The cost basis. And then when you sell it, it's just the value, the price, or the full market value, the FMV. That's a good question. So we would just pay taxes on this as whatever we sold it. So you're not investing in a 401k. This is just a bucket, right? It's what's inside that 401k, which we're going to talk about here in a minute. Does that make sense? Thank you. Good question. All right. Anybody else got a question? We have another. If you get a meme, you get to ask questions. All right. If we get a GIF, I guess. I don't know if you guys are GIF or GIF, but it's a. Are you leaving, Allison?
Oh no, I have a question.
Oh.
Okay, so personal example, but like this year for me, I'm not able to contribute a ton of money to my retirement fund, but I wanted to do some just to get started. And then I figured that I have an HSA account, and that would be the smartest way to do it for me. when I was talking about this with my mom, she got concerned because she was like, I don't want you building up all of the money in your HSA because what if you need to withdraw that money? But that's what emergency funds are for, right? So what's your opinion on like withdrawing from your investment accounts or
So
like 401ks or your HSA, you know, et cetera?
yeah, we don't want to withdraw from our retirement accounts, right? Retirement accounts are for retirement. HSAs are for health or retirement if we want to use it, right? So if you needed to withdraw from those accounts, it's already a bad day. So yeah, the statement that you made there was, Mom, that's what emergency accounts are for. Like I have emergency savings for that. That's sort of the vibe I want you to have. What if you need this money, you need to touch it? Yeah, I don't want to have to do that because I'm going to have to pay taxes and the taxes are going to be whatever it is, right? I have no control over that. So that's like 20%. And then I'm going to have to pay an additional 10% penalty to take that. Now, I said earlier that 401ks have like hardship withdrawals and you can take loans against them, but that is an extremely slippery slope that you will see friends, family, and colleagues getting to that I want you to avoid if at all possible, where you take a loan from your 401k because it's just hard to fight that back. You will have some plan sponsors, 401ks that'll convince you that a loan is the best bet because you pay yourself interest. But just say that a couple of times. You pay yourself interest. You're not making any money by paying yourself interest. You're just paying yourself. So loans from 401k is never good. Yeah, so those are good. So if you were going to put it all in the HSA, I would double check that your employer doesn't have a match. If they have a match, then we want to get at least a match.
They don't.
Okay.
At least not this year.
Not this year. That's pretty common this year. So if in the future, if they have a match, we always want to get the match because that's 100% return on your money for the most part. And that's just free. So let's always take free money. If anybody's handing out money, just take that money. That's free. So good question. Totally worth the wave. All right, so different types of investments. So I've been kind of talking about different things, but I want to make sure that we're all on the same page and I want to explain what they are. So when we talk about cash equivalents, those are pretty easy to understand. Everybody's with me there, right? So things that look, talk, sound, smell, quack like cash. That could be money market accounts. That could be actual physical cash. That could be treasury bills, which are like bonds from the government that only last a couple days or weeks. CDs, this could be commercial paper, which is like overnight lending to stuff. But for the most part, this means money in your pocket and money in your bank account. When I say bonds, I also use the term fixed income. What that means is it's debt, right? It's an IOU from somebody. It could be an IOU from government, US government, city, municipal, tribal. It could be from a corporation. Let's say Tesla wants to build a new battery factory just outside Houston, Texas, and they don't want to use their own money because why? So they'll borrow money from you. They say, hey, please loan me money. I will give you a 4% return every year, and then at the end of 5 years, I'll give you your money back, right? Let's say your local government wants to build a new highway, and they don't have the money to do it. They'll put out a bond, and they'll say, loan us $1,000, and then they'll sell that to thousands and thousands of people. They say, give us $1,000, we'll pay you 3% per year, and then at the end of 20 years, we'll give you your $1,000 back. That's how fixed income works. Stocks, also called equity, is just ownership in a company, right? So if you buy one share of Apple, you are technically a very, 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 very small owner of Apple. And you are treated as such. So when all the owners want to take profits, you get a piece. When all the owners get together to vote, you get a vote. Doesn't really mean much, but you still get one. Probably the same as our election. So that's kind of how it works, right? So when the owners want to take profits out, it's called a dividend. So you have some companies are what's called dividend companies. So they're going to give out a big percentage. You'll also hear different types of stocks. Like people will want to sound smart. They'll use terms like, oh, this is a blue chip stock. All blue chip means is it's highly regarded and they're cash flow positive, right? So think Apple. You'll have like growth stocks. They'll use that term. So growth just means they have good sales, they have good earnings, and the market share growth is expected to exceed the industry. So that's mostly tech companies and big stuff like that. You'll have income companies. So incomes are the ones that pay that regular dividend. So that's mostly like utility companies like Verizon Wireless. You can have cyclical companies, right? So they go up and down with the business cycle. So they have ups and downs depending on the year. I don't know, like Christmas tree companies, that would be pretty cyclical. You have value-based companies. So things that are underpriced right now based on historical averages. I used to use Chipotle as an example of that. So remember when Chipotle started killing people with norovirus and everybody stopped going to Chipotle? I never stopped. I would still go to Chipotle even if people were dying. But right now, think like airlines, cruise companies, right? Things that are undervalued based on their historical relevance. There's defensive stocks. Defensive stocks are things that are generally unaffected by the overall market. Think tobacco, alcohol, utilities, pharmaceuticals. People still got to take their drugs, whatever they are, when up markets and in down markets, right? People still got to keep the heat on, no matter if it's up or down. And there's like interest sensitive stocks. So that's things that like when the interest rate moves, like mortgage companies have interest rates that move, student loan providers have interest rates that move, those companies are more impacted by that. So there's a bunch of different terms out there on how investments are classified, and everybody's going to come up with some new cool term, but it doesn't really mean anything. Any questions about that so far? All right, mutual funds. Let's talk about mutual funds. So does anybody know what a mutual fund is? No. A mutual fund is a way for you to get more diversification for less money. Okay, so I'm going to teach you about a group of funds here. We're going to talk about FAANG, F-A-A-N-G, Facebook, Amazon, Apple, Netflix, and Google, right? So the big tech players in the US, pretty easy. So a lot of people, they say, I'm only going to invest in FAANG companies, F-A-A-N-G. And they want to go out, they want to buy a bunch of shares of all of them. And then they realize that, oh my God, those are very expensive companies. So if I want to go out and buy one share of Facebook, Apple, Amazon, Netflix, and Google, it's going to cost me thousands of dollars. Well, okay, I can't do that. So what do I do now? I can either go out and I can buy maybe FAN and get FAN, Facebook, Amazon, and Netflix, or I can figure out what I want to do. This is when a mutual fund would come into play. So a mutual fund would go out in there and they would buy all 5 shares and they would sell you a piece of it. So you wouldn't own one share of each of the companies. You'd own a piece of each of those companies relative to whatever I make that mutual fund, right? So maybe I go out as a mutual fund company and I create the FAANG mutual fund, F-A-A-N-G, and I buy 1,000 shares of each of them and I can sell you a piece of my 1,000 share bucket. Does that make sense so far? All right, that's a really simple explanation of mutual funds. Mutual funds can be extremely complex. Let's say I wanted to buy stock in companies that are female owned with 50% female boards, like board of directors, that do business in California, New Mexico, and New Hampshire only, right? I can get very specific. And then a fund company will go out there and they'll find those companies. Or let's say I want to invest in the whole stock market, all the S&P 500. But I don't want to go out and buy one share of each of those 500 companies. I just want to buy all 500 at once. I can do that in a mutual fund. Does that make sense generally? All right. So they can be as complex or as specific or as general as they want. Anybody can create them and they just sell pieces of it, right? So it's a way for investors to pool money together effectively and buy more shares, right? So the advantages are you get more diversification for your money, right? So instead of just buying FAN, is all I can afford, I get the FAANG. Investors, I get economies of scale, right? So if I'm buying in big bulk things, I can get better prices. I have easy access, so there's more people who want these funds. I can purchase smaller denominations, meaning instead of having to purchase whole shares or more, I can purchase marginal shares. There's more liquidity, right? So instead of having to be able to sell all 5 individual shares, I just have to have somebody who wants to buy my bucket of shares. It allows for easy comparison between stocks and funds, and they're normally managed by a professional. Disadvantage, that professional charges you to create it, right? And this is not your advisor, right? Like YFP, we don't create mutual funds. Some bank out there creates mutual funds, and then we would buy the mutual fund from them. Does that make sense? So individual advisors don't just make these funds. Some of the disadvantages, the price. So you have to pay a fee for that to exist. There's no intraday trading. I mean, there's no trading throughout the day. So because I have all 5 of these shares, I don't really know what they're all valued at the same time. So I have to wait till the end of the day. When the stock market closes, I find out what the value of all 5 companies was, and that tells me how much my bucket is worth, and then I can sell my portion of the bucket. Can I get a head shake or two of that? All right, good. I never explain this the same way, so it's always like fun how it comes out. I wish I had a script, but I don't like using them. And then they're subject to like herd mentality. So a lot of times, man, that FANG companies, they're doing great. Everybody's gonna like run off and chase it, right? So that's a problem. And then also the taxes. So let's say I wanted to change FAANG. I wanted to get rid of Netflix because Disney Plus is killing them, and Netflix is a joke. So I'm gonna replace Netflix with NVIDIA, which is like a graphics card company, computer chip company. It's a big company, Allison, don't worry about it. I don't know another company that starts with N. Newman's Own? I don't know. So we're gonna replace it with something else. So when they sell all their Netflix, they have to pay taxes. So who do you think's gonna pay the taxes, them or you? It's you, it's always you. Nobody pays the taxes but you. Doesn't matter what's happening, it's just assume it's always you. So there's taxes that may have to come in there. So the more complex your fund is, and the more in and out it has to trade, the more taxes are gonna be. Does that make sense? All right. Now there's another one here called exchange traded funds. So exchange traded funds are extremely similar to mutual funds. They give you the same kind of diversification. They do the same thing. They give you all the spread, but they're treated a little differently. So it's a portfolio of assets, but the shares are traded on the stock market. So you can trade throughout the day. So instead of having to wait till the end of the day, you can trade throughout the day. All right, so that's one plus. They're generally also passive, meaning they're not as aggressive or active. So there's not somebody buying and selling things in and out of it throughout the day. So there's generally less taxes, which is a good thing for us. So characteristics, they bundle things together. They're traded on the exchange. They have specific investment objectives. Generally, they have like a goal. Hey, I want to be the whole stock market, or hey, I want to get those female companies that only do business in California, New Mexico, New Hampshire. I don't know why that was my example. Some advantages: they're generally cheaper than mutual funds because they're less active. So there's less people sitting at computers typing away. You can buy them at a known price because you know what the price is throughout the day. You get the same diversification, the same easy access, the same liquidity. Dividends invested are invested immediately, so you don't have to like get cashed out so you can buy more. It allows for easy advantage comparison, and they're also a little more tax efficient since they're not trading as often. Some of the disadvantages: sometimes it costs more to buy those smaller denominations, so sometimes it's cheaper to buy a bulk. Sometimes the bid-ask spread, which is a term I want to tell you guys. Let's say you want to sell that Apple stock that we bought. We have one share of Apple. We want to sell it. We're going to say we want to sell it at. That's what we're asking to get paid. And then someone else is going to bid on it, and they're going to say, this is what I would be willing to pay. And there's a gap there, right? Just when you sell everything, there's always a gap there. That's called your bid-ask spread. Sometimes the bid-ask spread can be higher with ETFs. And sometimes they're going to cost more than the stocks within them, but it's the only way you can afford it, right? So very similar to mutual funds, just a little different. We generally prefer ETFs because they're cheaper from an expense standpoint. Does that make sense? All right. All right, we got a gift, so we got questions. No questions right now. You guys are all superstars at this. Perfect, okay. So has anybody ever heard of Morningstar? Perfect, okay. So earlier we talked about Standard & Poor's, the S&P 500. This is another rating agency. So Standard & Poor's rates companies and their size. Morningstar rates mutual funds. And it says, yo, this dude over here, he's got this FAANG fund. He's killing it. 5 out of 5 stars. And then they'll post it and everybody will be like, oh my God, I need it. And then they'll go buy it. Hey, this company's doing terrible. He sold Netflix for NVIDIA. Stupid guy. 1 star. Everybody's like, oh, you gotta sell it. So they get rid of it. So you get that herd mentality kind of going for it, right? So we think this is generally a poor way to do business because just following the herd is never the best idea. So we want to ignore that. So when we're talking about rating mutual funds or in ETFs, we want to look at their fees. So we want to be able to compare fees, right? So there's a bunch of different types of fees that you could have. You could have trading fees, which is like commissions when you buy and sell something. These are kind of going away for the most part, but they're not all gone. So it used to be back in the day, you have to call your stockbroker like Wolf of Wall Street style, and he'd charge you like $50 or a percentage point to buy a stock. Now you can just go online and buy it for free on Robinhood. So everybody's having to get rid of commission. So these are kind of going away. Platform fees, you'll see these with your 401ks. They may charge you like $35 a year. They may also charge you like 0.5% per year just to exist. Administrative fees, this is just like somebody saying they're doing paperwork, but they're really not. So they charge you a fee for it. And then expense ratio. So when someone created that mutual fund, right, they're actually working there creating the fund itself. They charge you a fee for the fund to exist, right? Everybody good there? Okay. So I can't control trading fees for the most part. I can't really control platform fees if I have to be on the platform. I can't control administrative fees, even though Karen is not really doing that work. She's still going to charge me for it. But I can control expense ratios because I can choose a different fund. So let's focus on expense ratio. So let's say we have $100,000. Congratulations, you finally made it. So we have $100,000 and we're going to invest in one mutual fund. If we're looking at 2015 averages, an actively managed fund, so somebody who's really like focusing and they're working at their desk all the time, they're going to charge you 1.45% on that. I'm going to teach you guys a new term that you don't need to remember, but I want you to hear it. It's called a basis point, okay? So I get tired of saying all these percentages because it starts to get confusing and maybe you misplace the zero in your head. So 1.45%, easy to say. 0.05% can start getting confusing if someone's not listening all the way. So if 1% is $1, 1 basis point is 1 penny, okay? So this is now 145 basis points. This is 5 basis points. Is that cool? All right, I'm gonna use the term basis points from now on. Anybody who didn't come to class today, they're gonna be confused as shit next time. They're not gonna know what we're talking about. Don't worry about them. All right, so this actively managed mutual fund over here, they may be charging you 145 basis points, which on your $100,000 is like $1,500 a year. So just for this fund to exist, they're gonna charge you $1,500. Okay, it better be doing great. But because I can create mutual funds that all do kind of the same thing, you can find other mutual funds that are extremely similar that just cost differently, right? So let's say we have an actively managed person who does this. Maybe we have a person who does the same thing, but they don't buy and sell as often. They're a little more passive. They do the same thing effectively, but they only charge you 73 basis points. So it only costs you $700 a year. Well, that's way better. Then you may have an ETF instead of a mutual fund, so it's a little more tax advantaged. Pay a little bit less, 60 basis points. And then YFP. We try to find the most cost efficient portfolios. So we don't write our own investments, we don't do anything like that. We just pick the people who are doing it best. Vanguard, Charles Schwab, BlackRock, right? We're not smarter than anybody else, we're just picking stuff, right? So we try to find things and get it down to like 5 basis points. So if we're saying this guy's trying to do the whole stock market, that's what his mutual fund does. It tries to match the market. Well, this guy's matching the market too, but he's only charging 5 basis points. I'm gonna go with that one, right? So that means I should be doing 1.4% better per year than this guy because I'm charging less. Does that make sense? All right. When I say YFP portfolios, these are not portfolios that we like create ourselves. We just pick and choose stuff. All right, cool. Any questions so far about expense ratios? If you hear about this in the future, the place you're going to see this is in your 401k. So when you look at that, like Allison, next year when you have access to like a 401k stuff and you're looking at it and they have all these funds listed out, you're not going to know what any of them are. Actually, you're going to know everything because you learned today. But you're not going to know what any of them are, and you're going to look at them and you're going to say, man, this one has an expense ratio of 90 basis points, and this one has an expense ratio of 12. All right, well, do these things do the same thing? If they do, why would I pay 90 when I can pay 12? If they don't do the same things, which is going to be the case as well, then I would just want to compare apples to apples. Cool. All right, asset allocation. Does anybody know what asset allocation is? We're not really smart, so we just exactly what it says. So it's the allocation of your assets, right? So it's just how you diversify, right? So what is asset allocation? Asset allocation is just combining stocks and equities, right? So earlier I said like the YFP 100-0, 100% stocks, 0% fixed income. That's your asset allocation. So it's the strategy of creating a personalized portfolio of combining stocks, bonds, cash equivalents, and very different things. There's a science to engineering it. There's like an art behind it. But realistically, we just want to find that risk portfolio that you're not going to freak out when the market does something, where I'm too invested and I freak out because it's down, or I'm not invested enough and I have like hella FOMO because the stock market's up and I'm not, right? So that's what we want to find. So the goal is to reduce your risk as low as possible while enhancing your return, right? So we want to get a good split there. And then you have your objective, right? So our objective is to determine what investment categories we want to use, and then what's the appropriate percentage in each of those categories. So we'll talk about that. So when we look at like the value of asset allocation, so just the asset allocation, so just that 100-0, 80-20 makes up like 91% of your return. The actual investments we choose, so the actual like stocks we choose or mutual funds we choose, only make up about 6%. Timing the market, meaning guessing when the market's up or down, only makes up about 2%. And then you get like 1% for like everything else. So really this is the deciding factor of if you're going to be successful in investing. It's not picking winners and losers, it's just deciding what kind of categories you want to play in. Does that make sense? All right. So when I talk about categories, we got to define some of these. So let's talk about equities. So we're talking about stock market right now, right? So we have domestic, international, emerging market, and real estate. So when we talk about domestic, these are some terms you may have heard. You may say things, oh man, we got large cap stock, we got mid cap, we got small cap. Well, what does that mean? Cap stands for capitalization. It means what's the value of this company according to the stock market. So a large cap or large capitalization company means it's about a $10 billion plus company. So these are all the biggest companies in America, right? And mid cap is anything that's valued between 2 billion and 10 billion. It's pretty middle of the road there. Small cap is anything 300 million to 2 billion. 300 million is still a huge company, but relative to this, it's small capitalization. Does that make sense? Obviously, these companies are going to act differently in a natural circumstance. A company that's this big, think of like a big aircraft carrier, they can't make big turns, okay? They got to move slowly. Walmart can't make big old moves. Think about down here, 300 million to 2 billion. This is what like Lyft used to be. They could make a big turn. They could pivot. They could turn that couch in the stairwell like Ross, right? They could get that pivot going. So they can make different moves. So they may have a different return projected. These are all domestic, meaning US owned companies. US owned, that's what we care about. Not where they live, not where they operate. Apple's got factories all over the world. They keep most of their money in Ireland. They're still a US company, domestic. International is basically any company that is not owned by the US and is owned by a stable foreign power. Stable is really subjective, but think about the big countries in the world. So UK, France, Germany, Japan, Australia, right? Big, powerful, like well-known established countries. Any company that's there. So BMW, Toyota, Kia in South Korea, all these companies. Emerging markets are the other international countries, the companies that are there. So a little less stable, right? So Eastern Europe, Africa, the Middle East, Latin America, China is actually an emerging market because they're not super stable. So that's how we define it. So we want a little bit of all of these, and then real estate. So real estate may mean owning actual property. It may mean investing in a real estate investment trust, which is like a mutual fund for real estate. So think about all the malls in America. We were talking earlier about malls in America before you guys got on. And somebody owns those malls. And they can put all those malls into one mutual fund, and you can own a piece of that mutual fund, which would allow you to own all the malls in America, a small piece. It allows you to do that. Also think like old folks' homes. Grocery stores generally don't own their property. So like the Krogers that are all out there, somebody else owns the physical property and you can invest in that. That's another way to get real estate. So when we talk about fixed income, right? So this is debt or bonds from somebody. You can have government, again, that's federal, state, local, tribal, municipal. You can have corporate, that's directly from a company. So any company you can buy stock from, you can buy bonds from. They're generally riskier because companies go out of business more often than countries do. Anything international, just anything outside the US. We talk about, you may hear the term duration. You may not ever hear these terms, but basically we care about short-term, long-term, and intermediate. So how long does it take me to get my money back is effectively what that means. And then you may hear things like investment grade or junk bonds. What does that mean? So earlier we talked about S&P 500, they rate companies. We talked about Morningstar, they rate mutual funds. Now we'll talk about bonds. Those are rated by a company mostly called Moody's. So Moody's rates bonds, and they go everywhere from like really little, like low letters, like D, stuff like that, all the way up to like AAA. So however high they're rated is how likely they are to pay you back. So the US government actually used to be AAA rated. A couple of years ago, we got downgraded to AA. And that was a big deal because it means that we're less likely to pay our debts. Now we're still AA rated. We're still very high up there, but we're not like the bee's knees anymore. So basically a junk bond is just anything that's not classified as investment bonds. So that's really anything like BB or less. So anything that's below BB is not investment grade. So they call it a junk bond. Doesn't mean that it's junk, but it means it's less likely to pay you back, which means you should get a higher return for your investment. Something's less likely to happen, I better get paid more, right? If I want to bet on the 00 in roulette, I get paid out 32-1, rather than if I bet on red, I only get paid 2-1. I don't know if anybody else gambles. All right, any questions so far about investments? All right, we're gonna talk a little about retirement. We're gonna do a little worksheet that hopefully you all looked at, and then we'll go back to questions. All right, so retirement stats. Half of Americans have less than $10,000 saved for retirement. 10,000, okay? So very shortly, a lot of you will have more than half of what America has saved for retirement, and you're all pretty young. 76% of baby boomers are not confident that they have enough saved for retirement, which is really scary because baby boomers are currently retiring. So 76% of them think they don't have enough. 55% of retirees retired earlier than they expected, right? Because of health reasons or job loss, meaning you can't put off your retirement savings forever because you may have to retire earlier than you planned. Full retirement for baby boomers was projected at like 65. For younger people, it's like 67. For us, full retirement age, probably something like 70, but you can retire whenever you have enough money. You don't have to wait until whatever full retirement age is. You can retire at 40 if you can ball out, or just live cheap enough. So decide what your life is going to look like and then make a plan to get you there. Does that make sense? All right. $245,000 is how much a retiring couple in 2015 would expect to spend on healthcare throughout retirement, right? So we can't just project our expenses going forward. We have to add in some other stuff. So when you get old, you get sick. When you get sick, you have to go to the doctor. When you go to the doctor, they make you pay for it for some reason, as of now. And we'll see what changes on that. All right, so what's the retirement landscape look like a little bit here? So there's always constants, right? So just like I started this conversation, we always have taxes and inflation. They didn't go away just because we entered retirement, right? Things are still getting more expensive over time, and there's government's still taking their bite of the sandwich. So we still have that. Debt. We don't want to have debt when we're in retirement. We don't want to have debt now. Think about having debt when you don't have income anymore. Like that would super suck, right? So avoid credit cards when you get close to retirement. Try to pay off your home if you can. Avoid having student loans in retirement, which sounds crazy right now when I say that because you're like, well, that's like 30 or 40 years from now. Why would I still have student loans? The largest group that are accruing student loans right now are over 60. So like people are still getting student loans, whether just for their kids or they're deciding to go back to school for those, I don't know, third careers. Pensions into 401k. So pensions used to be a really cool retirement option that a lot of people had. Not as much anymore. So now if you're like a federal employee, you may have this. If any of you go to join the government, the military, you'll have a pension. There are some companies that are still doing pensions, but most of you are going to have 401 something options. Social Security uncertainty. Who here thinks Social Security is going to exist when we retire? Yeah. Okay, so it's probably going to exist, but like how's it going to exist? So Social Security did not or was not created to be a retirement benefit. It was supposed to be longevity insurance, meaning you lived too long. Here's some money. So the original full retirement age was 65, but when it was created, life expectancy was 62. You were supposed to die before you got Social Security. It wasn't supposed to be around. So many people are dependent on it now that they can't get rid of it. It's not going anywhere. right? Also, that's the largest voting population in the US. So like they're not gonna vote against that. So what they've done a couple times now is they've extended retirement age. So they say, hey, it used to be 65, now it's 67. So you have to wait a little bit longer before you get that full retirement age. You can still claim benefits earlier, but you claim a lower benefit. Or you claim it later and you claim a higher benefit. So they're increasing how much of a lower benefit you can get and decreasing how much of a higher benefit you can get. By the time it gets to us, it'll probably still exist in some point, but that higher age will probably extend. Does that make sense? So when we plan for retirement, we're gonna pretend it doesn't exist because I don't know what it's gonna look like. So let's just let it be gravy, right? If Social Security is here in the future, cool, we'll take the kids on a better vacation. Like grandkids can get extra Christmas presents. If it's not here, cool, I didn't think it was gonna be here anyway. Yay me, all right? Increased health costs. I don't know if you guys know anything about like healthcare costs, but like they're really high. And it's the American way to just make things more expensive. So healthcare costs are probably gonna increase in retirement. Life expectancy is gonna get longer. So I told you weren't supposed to survive through Social Security. A child born today is supposed to live until like 88. So you're just getting older, like we're having longer time in retirement. So when we plan for retirement, it's not just I'm gonna be retired for 5, 10, 15 years. It's like 30 years, maybe longer. So you may be working in retirement. Maybe you're working less. Maybe you're all gonna go PRN, right? Maybe we're gonna start a second job. Maybe we're all gonna start companies. Only so many people can be on a golf course at a time. So it's like, what are we gonna do? All right. So what's effective retirement planning? Super important to know effective retirement planning when we're like 30 years old, but let's talk about it for a minute. So we want to define what we're doing. We want to diversify our investments. We want to optimize our sources of retirement income, right? So that's the same thing we've been talking about. We got all these tools. We got all these things we're going to do. We want to focus on paying down debt. I don't want to have debt now. I definitely don't want to have it when I lose my income. We want to be clear about what levers to pull. So this may not be important for all of you right now, but as you get closer to retirement or as your parents start to enter retirement, you can start seeing these levers that they're going to pull. You know what? I don't have enough money to retire right now. What can I do? Well, I can not work, not retire and keep working, or I can start investing more for retirement, or I can work in retirement, right? Hey, you know, I'm 10 years out and I have too much money for retirement. Well, okay, what does that mean? Well, I can retire earlier. I can have a baller ass retirement, or I can start saving less, right? It's not common. No one really has that problem, but it's something that you may have because we're all going to be super savers from a really young age, right? We want to encourage appropriate investment behavior, right? So appropriate investment behavior is kind of be aggressive when you're young, right? You have a long time horizon right now. I don't worry what happens in the next 5, 10, 20 years in my retirement accounts. I only worry about the long term right now. As you get closer, we'll worry more. Don't get distracted by the shiny objects that I obviously get distracted by, like Bitcoin. When I worked with retirees a few years ago, Bitcoin got huge. I had people yelling at me because I wouldn't let them invest all their money in Bitcoin. And I'm like, oh, this is stupid. You can't do this. And then they didn't do it. And then when Bitcoin went from 20,000 to 5,000 in a couple weeks after Christmas, they were like, I'm glad I didn't do that. I'm like, oh no. Imagine how it would have been if I let you do it. So let's avoid that. Outside of like the zombie apocalypse, we're pretty sure that population is going to continue to increase. Supply and demand is going to continue to increase the demand side. So market's going to go up. Companies are going to get bigger, more powerful, and more valuable over time. So we think the stock market's going to continue to rise over time. And we want to diversify, right? Do we account for Social Security? No, we don't. We just don't do that. And then follow a defined process. So we want to basically plainly state how we want to invest so that way we don't freak out when something happens. If I say I'm going to invest 5% of my salary every year, no matter what, cool. You just keep doing that. If I say I'm going to invest 20%, cool. Doesn't matter if the stock market's up. Oh, I'm going to cut my investments because the stock market's expensive. Don't do that. Doesn't matter if the stock market's down. Oh, I'm going to do more because the stock market's down. Don't do that. Just set a rule, find a plan that works, and just stick to it. Consistency is the most thing that matters here. Tim has a new thing he's been saying recently. I really like it, so I'm going to steal it. It's not about timing the market. It's about time in the market. Yeah. So it's cute. Trust me, it's cute. All right. So let's do a little practice here. Let's do this nest egg calculator. Do you guys want to change it up a little bit? Does anybody have any questions before I jump to this? No. Does anybody want to volunteer for something that they have no idea what it is? Austin's always a volunteer. Somebody else. Carol, you want me to volunteer?
Sure, why not?
All right. Okay, so here's what we're going to do. I'm going to pull up this nest egg calculator. Did you guys see this? I shared this in Mighty Networks, but I don't know what you guys see when I do it. Let's get bigify this. All right. Carol, how old are you?
24.
You're 44?
24.
I was like, Carol, you look great for 44. Okay, so you're 24. What's your target retirement age right now?
We'll just go with 65.
55? 55. All right, so that means you have a work life expectancy of 31 years. It means you're going to work for 31 more years. All right, and then how long do you want to live?
Oh, 41, 65, 65.
Oh, 65. All right, we'll change that later.
We're not being too ambitious.
So 41 work life expectancy. And then are your grandparents still with us?
Nope.
Nope. Any super longevity in your family?
Nope.
All right. So your life expectancy would be like 88. We're going to shoot for 95 because I always want to be more conservative, right? I don't ever want to get to a point where I'm like, you were really supposed to die next year. So if you can handle that, that'd be super. Otherwise, you're going to run out of money. So nobody ever wants to be a burden on their family. You've definitely heard relatives say that. So we're going to aim for 95. So that gives you a 30-year retired life expectancy. So in this projection, you're going to retire longer than you've been alive today. All right, that sounds pretty dope. Do you have anything saved for retirement right now?
Just 401k, that's it.
Do you have any money in it?
Yeah.
What do you have?
Like about 10,000.
10,000?
Yeah.
Yo, are you sure you're 24? You're not like 35?
One job was just all for the 401k. The other job was for checking.
All right, what are you earning right now?
What is this? Like 25 an hour.
Okay, what are you going to earn when you're balling out? Like 57 an hour?
Yeah, probably.
All right, so we're going to say like 120. I'm just going to leave this here just for simplicity's sake. So we got $10,000 saved for retirement right now. We're making 120 right now in the scenario. You're going to increase, you're 26, so we can this is real. All right, we're going to want to replace like 70% of that. So once we're retired, right, we're not going to be saving for retirement anymore. So I can take some of that out. I'm not going to be paying all the taxes I'm going to be paying for like employer taxes and all that stuff. I'm not going to have some of the expenses I'm going to have. So I want to replace about 70% of my income, right? So from 120, 70% of that's 84,000. Everybody tracking on that bunch? Yep, okay. Now we're going to make some assumptions here. So what's inflation? So right now the national average or historical average for inflation is like 2.6%. So we're going to say 3% because I want to be more conservative, right? I want to pretend inflation is a little bit higher. So it's 3% every year. Earlier, we looked at that investment return and it was a 10% before inflation and a 7% after inflation, right? Everybody, yeah, you remember that early on? Okay, cool. So instead of 10% and 7, we're going to aim for 9% before inflation, which gives me about 6% after inflation, right? So we're going to aim lower than the historical average for investment return because I want to be conservative. Once we get to retirement, we're going to be even more conservative. So instead of aiming for 10%, we're going to aim for 7, which after inflation gives me like a 4% return after inflation. Does that make sense? All right. So we have an annual need of $84,000. Do we think we're going to have any Social Security? No, we don't. We're not going to count for Social Security. But some of you may have a pension, right? Some of you may work for city hospitals. Some of you may have like teacher spouses in the future. Some of you may work for the government, and there may be a pension here. So maybe there's like $5,000 a year, but we're going to pretend there's nothing. So that means we need $84,000. With I have 3% inflation every year, my $84,000 is actually going to be like $266,000. So the $84,000 that I need today, just based on inflation, means I'm really going to need $266,000 every year. And I'm going to be retired for 30 years. So I need $4.8 million before I can retire. There's a bunch of ways to calculate how much you need to retire. This is just one of them. All right, does that make sense? Everybody tracking so far? I'm getting some focused, I'm getting some unfocused. All right, we're good. So monthly savings. So for the rest of our work life, right? Because I upgraded your skill level here. So you're level 26 instead of 24. So we're going to work for 39 more years. So I could save $1,136 a month, and that would get me to $4.8 million, assuming these returns. Because we already have $10,000, because you're a super saver, we only have to save $1,058 to get there, right? All right, so are you putting money in your 401k right now?
I was in the process of rolling over. I just switched jobs, so no.
What percentage are you planning to contribute?
I have to figure out what their match is and just do that.
Yeah, okay. So let's say they do 4% if you do 6. So that would be, hey, we do dollar for dollar up to 4, and then we do 50 cents on the dollar for the next 2%. So you do 6, they do 4. Does that make sense? All right. That's a pretty common one. It's not always the case, but this would be matching out. That's not a real term. I try to use it. It doesn't work. It's like fetch and Mean Girls, but I'm trying matching out. So you do 6, they do 4. So you're putting $600 in a month, and they're putting in $400 a month, right? So your combined contribution is $1,000. Do we have any money going into an IRA or anything like that?
No.
All right, so we got nothing going in an IRA. All right, so that means we have a negative deficit, or we have a deficit of $58 a month. So if all my projections are correct and are conservative, that means we're a little low right now. So as we go through time, we want to try to increase some of these numbers. So either A, we want to start putting money more into our IRA. Maybe we retire later. You know, maybe we're actually only 24. That does some things, but we're actually not in this one. So maybe we can say, okay, what if we start putting in 10%? Because as I age, I'm going to start putting more money in retirement. So I do 10, they're still only doing 4. Now I have, this is supposed to be green. Why are you not green? Pretend this is green because it's positive, right? So this one right here, we're doing 6, it's negative, and this one will be positive. It's going to bother me. All right, but this chart basically says I'm not quite on track for retirement. So that means I need to adjust it a little bit. Now, obviously, I'm saying you have, 39 levels before you get to retirement still. So you have a lot of time to make adjustments. And as you go, you're going to increase more, right? So we have this salary going up a little bit over time. We have all that inflation kind of baked in, but there's still going to be changes where your salary is going to go up by more than just inflation. Your salary, you're going to get promoted. You're going to change jobs. You're going to move laterally. You're going to move vertically. You're going to increase your savings. You're going to decrease your savings because you're going to have like a larger family or more dogs, which is what happens in my house. You're going to have to do all this and that, right? Some of you are going to take loans from your 401k. Don't do that. Some of you are. So all this is going to get changed. But right now, we're only $58 a month away. So right now, we're really close in this projection. So I'd feel pretty good about that. Some of you all have access to this program. Download it, use it. Some of you are going to look at this and say, man, I'm like positive 200. Congratulations. Some of you are going to be like, well, I'm not saving anything, so I'm negative 1,000. Cool, it's fine. You're like a resident. Like you'll figure it out. Hey, I'm focusing on paying back student loans first. Okay, that's fine. Once we build out that plan to say, after I pay off my student loans and I free up that $1,000 a month I'm paying right now, where's that money going to go? Is it going to go straight back into my 401k so I can catch up to where I think I should be? The problem you're going to have for a lot of you is you're going to look at your peers, and your peers are fucked. They're not saving enough. So don't look at your peers. Like, look at your plan and your goals and to figure out where you're supposed to be at, right? Your friends are going to be like buying all this junk that they don't need. They're going to have these doctor cars and doctor houses you're going to be super jealous of, but you're going to be like, I'm not going to have to work till I'm 70. I'm going to save a lot of money in here so I can retire at 60. Or I'm going to save a lot of money outside of here in like a individual account so I can retire at like 50. And I can just be like a beach bum. Or I can just make all the cutting boards I want and have a whole huge wood shop that I can do what I want. And I don't have to worry about nobody. Right? Does that make sense? All right. So you have access to that tool. I didn't have to do that. Use it if you want. Let's go back in here. Any questions?
Was the sheet sent in an email?
It wasn't. It's saved in Mighty Networks. You have access to Mighty Networks, right?
Is that where we uploaded our info in the last meeting?
No, that's Right Capital. So Mighty Networks is like our group discussion board that nobody uses. We should just use Facebook, I think. Kim, let's make a note to send out a link to Mighty Networks to make sure that she has access.
Thank you.
Cool. So in there is also, if anybody doesn't sign in to Mighty Networks, there's also access to all these videos that I make for all these, like slideshows. They're all saved in there. Anything that we have that's like the worksheets we work on, those are all going to be in there as well. All right, save you. Sorry, I shouldn't have closed it out. Anybody else got a question? That's a good one. If I ever talk about saving files somewhere and you don't know where they're saved, that's a wonderful question to ask. Because maybe I'm forgetting to save them. All right. Okay, so before we did this, I said we always want to follow a defined process and review the plan regularly, right? Like we talked about, we don't have rules that say what we do. What are those rules called? We call that an investment policy statement. So no matter if you're doing stuff on your own, or if you're working with an investment advisor, or if you're having like Dr. Joe, who really thinks he knows about investments, doing it for you, we kind of want to have a rule set. So what we have, it's called the investment policy statement. So I'm going to show you what ours looks like at YFP. So that way you can know what it should look like for you in the future. They're all going to aesthetically be different, but the bare bones are there, all right? So this is an investment policy statement. So this is saying, hey, I'm investing in a 90-10 portfolio, meaning 90% equity, 10% fixed income. It's plainly stated there, right? I want it to be moderately aggressive growth. It's going to be here for so many years. It's signed by me and my investment advisor. So we're all agreeing to what's about to happen. As we go through here, we say, hey, these are the stocks or ETFs I want to invest in. So a little quiz or a little review here. So a Schwab US large cap ETF, right? So a large capitalization US company, ETF, exchange traded fund. We want to be about 35% of our portfolio. Down here, we have like iShares, which is just a company, Core US REIT, which is that real estate investment trust. ETF, we want that to make up about 5% of our portfolio. Does that make sense? So this is basically saying, hey, these are all the things I want you to invest in, and these are the weightings I want you to invest them in. But over time, they're going to move, right? Let's say large companies in the US start doing gangbusters. They're just going great, and like foreign companies, emerging markets are doing bad. This 35 might turn into 40, and this 10 might turn into 5. So I'm out of balance. I said I wanted to have 35 and 10, but I have 40 and 5. That's not okay. So you have to have a rebalance. So every once in a while, you want to sell some of your winners to buy some of your losers. In stock market, you want to buy low, sell high, right? That's like the general term everybody understands, but that's not what really happens for most people. Most of the time, stock starts rising. Let's think Bitcoin. Stock starts rising. Everybody wants to buy it. Stock starts going down, everybody wants to sell it. So you're buying high and you're selling low. It's the exact opposite of what you're supposed to do. But when you rebalance, you sell your winners, you sell high, and you buy your losers, you buy low. Does that make sense? So you're nodding because that sounds super obvious, but if you just do that, you're going to do better than most people because most people just follow the trend, and you want to not do that. You want to set your rules and stick to your rules, okay? A little bit more information that's generally going to be in an investment policy statement, kind of how it's broken out, right? So here we have the companies we're going to buy or the investments we're going to buy. This shows actually what it is. So we have 31% in large cap stocks. We have 0.8% in non-US bonds. We got some cash in here, right? It all should equal 100%, obviously. A little bit more like what's it split up into? Hey, we have like basic materials, consumers, financial services, we have energy, industry, tech, healthcare. You want to make sure you're not overweighted too much into one sector because then you don't have the diversification that you would otherwise. If you invested all in financial services, maybe you're diversified by the company, but if something happens to the financial market, then you're still fucked, right? So you want to make sure you're spread across sectors. You want to make sure you're spread across the globe a little bit. Everybody's going to have a national bias, right? So the US actually makes up about 55% of the world stock market, just because our companies are everywhere. So in theory, we should be investing about 55% US, 45% everybody else, but everybody has a bias. If I lived in Australia, my investments would be mostly Australian. If I lived in Japan, my investment would be mostly Japanese because that's where our bias is to. But this is just to show that you don't have too much of a bias, right? So North America, so Mexico, the US, and Canada, we're about 78%. Japan, 2%. Europe developed 6%, right? We want to make sure we're not overweighted to one country too much. Kind of the analysis on how we're split up in the bonds. What's our performance, right? So I can't tell you what your performance is going to be in the future, but I can look to the past and I can do a stress test and I can say, how would this perform in the past? And I can say, okay, so this is that chart from earlier, 2000, 2020, kind of what would it have done? We'd be up about 300%. Sounds pretty dope. That's just this 20 years. That's not every 20 years, obviously. But that's kind of how we would have done 1 year, 3 year, 5 year, 10 year. When you look at your 401k investments, you're going to see this chart and it's going to be confusing because some are going to be really good 1 year and really bad 3 year. You're like, well, that doesn't really make sense. That's just the year. You know, sometimes the stock market's up for the year. Sometimes it's down for the year. Sometimes it's like just level because it had ups and downs, right? We want to just be able to compare apples to apples. Kind of performance year over year. You can see how this would have done. We had a bad year in 2008, just like everybody else. Kind of expected returns, kind of what kind of dividends are we going to get? If we were looking for dividends, what are those going to look like? Stress test, how would we have done in those markets? Expense ratios. This is a big one, right? So earlier we said expense ratios are super important. So like what are the expense ratios of the funds that we selected, right? So this is our portfolio that we choose. We choose pretty low stuff. So 11 basis points, 3 basis points, 4, 4, 4, 8, 4, right? Overall, 5, right? So different weightings have different numbers. So even though this is 11, it's only 10% of the portfolio. This is 3 and it's 35. That's how we get to 5, right? So weighted average. You want to make sure that your investments are not super expensive. If 2 funds do the exact same and one costs you 1% more, it's just going to be 1% less return. It's obvious when you say it this way, but it's not obvious when someone's selling it to you. I know I sound like a salesperson, but I don't sell you anything. I use my powers for good rather than evil. When we look at the different investment breakdowns, 100% investment in the stock market, 0% in the bonds, that's pretty aggressive growth. This is where most of you should be when shooting for retirement because you're all pretty young. And you should be that way for a long time. There's some old adages where like you take 100 minus your age and that's how much should be in the stock market. That's cool if you want some rule of thumb, but in reality, 100-0 will get you there for a long time. We don't have to worry about it. So I'm 31 right now. I'm 100-0 and I'll be 100-0 for years to come because I have so much timeline, so much time horizon to get there. For other investments, not retirement investments, something that I'm going to need in the shorter term, maybe I'll be down here, 40-60, 60-40, something like that, right? Something I don't have 30 years to get to. I only have 10 years to get to. Maybe I'll be a little less risky. When we look at those portfolios again, they're going to have different ways they act. So that purple line, that 40-60, it's a little more stable, right? But you don't get the big swings. So I want the big swings if I'm that's what I'm looking for. All right, so questions. That's a lot. Nobody's got questions. I'm doing phenomenal. Okay, cool. So kind of what's our philosophy here? So Tim and I, Tim Baker, you've all kind of heard about him, so have grown up in different areas of the country, different kind of teachings, but we've all had the same 2 mentors really. So the expensive mutual fund guy, and I say guy because my industry is overrun by men. So if any of you want to make a transition, we'll take you. But we had an expensive guy who bought all those 5-star mutual funds, right? Because they're 5 stars and everybody knows they're 5 stars, they can charge you a bunch of money for it, right? So they're real expensive. And then we had the actively managed ETF. So that guy who's out there getting those really cheap funds, but he's trading them all the time. He's swapping them out. He thinks he's smarter than the guy next to him. So he's paying a bunch extra in taxes, right? So I don't want to buy really expensive shit and I don't want to sell it all the time. So what do we want to do? So what do I think you should do going forward? You definitely want to agree upon a set asset allocation. So kind of figure out what that fund is. Is it 100-0? Is it 90-10? What's it for? And then how do you use it? And then you want to buy the market. I don't care about beating the market. I want to buy the market. If the market, good dab. If the market's going to do, if the market's going to do 10% with that, before adjusting for inflation every year, cool. Let me just get that. I don't need to get 12%. I can build a plan where 10% works. I don't need to shoot for the fences, right? I want to purchase low-cost, passive index funds, right? I want to purchase low-cost stuff. I want the lower expense ratios. I want to be passive. I don't need somebody actively buying and trading every day. And I just want to kind of get what the market gets. And then I want to rebalance like twice a year. right? So I don't need to rebalance all the time. My stocks can get a little out of whack, but if they get crazy out of whack, that's when I want to do it. And then once or twice a year, kind of on your birthday, whatever, like set whatever that time is, and then just rebalance. Hey, I rebalance every time the clocks change, whatever you need to do. Some don'ts. What do we not want to do? We don't want to try to time the market, right? You're hearing people say all the time, and you'll even hear me say it from time to time, yo, it's a great time to buy. Well, it's always a great time to buy if your timeline's 30 years. So there's like the stocks are going to be up 30 years from now, so it doesn't really matter. So there's no like it's a great time to buy because nobody knows what tomorrow's going to look like. I have a bunch of shit on these shelves. None of them is a crystal ball. So I don't know that tomorrow's going to be better or worse than today. So how do I know that today's a great time to buy? I do know long term I have that positive slope on that chart. And I know long term we're going to have a return on our investment. So that's what I want to do. I don't want to pick home runs, right? I don't need to swing for the fences. Then we just get those singles and doubles. If I save like I'm supposed to save, you save like you're supposed to save, a single and a double is going to get you there, right? We're playing money ball, okay? It's Oakland A's baseball, right? We're not the Yankees. We're not shooting for home runs. We don't want to have the mentality that we need to beat the market. We don't need to be smarter than anybody else. The market's doing just fine. I can count on that, and we can roll from there. It's not going to do exactly what I want every single year, but on average, we're still going to get the average. We don't want to try to make investments sexy. As cool as I make it sound, this is boring stuff, okay? You don't get excited about your bank account giving you an investment return. Why should your investment account be any different, right? It's not like the movies where people are sipping martinis at the bar talking about trading stocks, right? It doesn't need to be that way. And you don't need to get that excited for it. It can be boring. It can just be a thing that happens. And don't listen to talking heads, right? So there's this show on CNBC. I think it's on CNBC. I used to watch it when I was a kid because I'm a super dork. And it's called Mad Money. It's this guy called Jim Cramer, and he's called Mad Money, and he talks about stocks and everything, and he throws shit at the TV, and he's got all these buttons, and they hit him and go, buy, 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 sell, sell, sell. And you'll hear him talking about the coolest stocks to buy right now. Ignore that dude. Like all he's doing is he's getting lemons to like follow the trends up and down. They're buying high and they're selling low. Sure, they're going to get some winners. They're also going to get some losers, right? Just like you. So what makes any difference? Like why have the stress to go along with that? Let's just get the market and kind of go from there. Does that all make sense? All right. Some recommendations here, right? So allocation. So consider an aggressive investment allocation, either 100, 0, 90, 10 for our retirement assets. We want to review investments in the 401k, IRAs, and other accounts, right? We want to review our portfolio as a whole. So we don't want to just view this one and this one and this one, because let's say they're all a little bit out of whack, and then as a whole, you're way out of whack. Does that make sense? So you want to kind of view your portfolio as a whole, everything, all encompassing. Organization, right? Consider establishing an HSA, assuming you have a high deductible health savings plan. Establish a Roth or traditional IRA if you have access, if you're eligible for them and you want to save in them. For most of you who have student loans who are going for some form of forgiveness, Roth IRAs are out right now. Don't do a Roth IRA if you're going for student loan forgiveness. You want to be traditional everything. You want to decrease your income as much as possible to make your student loan payments as much as possible, to increase the amount of your forgiveness, to save you money in the long term. Once that's forgiven, then you can go Roth, right? Then you'll be a baller, you'll have all this extra money. Consider establishing taxable accounts if you need them. So let's say you're saving for an opportunity fund, right? Some goal in the future that it's unnamed. Let's put money aside for that. Let's put it in a taxable account. We don't save for non-retirement things in a retirement account. Allison, tell your mom. Contributions in order. This is kind of the way to go. We want to get the match at our 401k, 403b, 457, whatever it is. Let's get at least that match if we can. If your budget's not there yet because you're a resident, okay, cool, your budget's not there yet. You'll catch up later, like it's not a big deal. But if you have the budget space and you want to save for retirement, let's at least get the match in the 401k, 403b, TSP, whatever. Then we want to review it, make sure it's not crazy expenses. Some of those are going to be hard to find, but an investment advisor should be able to help you. Then we want to max out the HSA if we have access to one. That's $3,550 for a single person, $7,100 for a family. Max out our IRAs if we are eligible and have access to them. And then if we still have money, let's go back and max out that 401k, even if there's a lot of fees, right? Saving for retirement is still going to come out ahead if we get the tax advantages. Does that all make sense? All right. So let's wrap her up here. My favorite slide of the day is always just this question one. We spend far too long looking for these little pictures that have questions. So if you have good ones, again, I'll always take advice. So what questions do we have? First, related to anything today. And we talk about a lot today, so like everything's kind of related, but like Any questions about investments or retirements today?
I
I
have
have a question.
Ooh, one at a time.
you first.
Okay.
Go for it.
Okay. So if I had an HSA account from a previous job, but my current job, I'm not using the high deductible health plan, can I still contribute to the old HSA account?
No. If you have an HSA from a previous employer when you had a high deductible plan, but you do not have a high deductible plan anymore, you can no longer contribute to that account right now. You can maintain it. You can still have it. Like if it's over $1,000, you can invest it. You can actually use it. So you can take the money out for health expenses if you need to, but you can't contribute any new money until you're in a new high deductible plan. That's a good question. And also you can roll it over. So I didn't mention rollovers very much today. So I'm going to answer Brittany's question. I'll come back to rollovers, but you can roll that to your new plan if you ever have another one. So Brittany, what do you got?
So in your recommendations section, you have like the steps, a lists of things that you should, max out first and second and third. What timeline do those happen? So I do my match with my 403B, which is what I have now, and then I start, maxing out my HSA. Like, what's the timeline between making those two things happen, do you think?
Oh, are you talking about like chronologically or like the gap in time?
Like the gap in time. Am I going to max out tomorrow and just start giving whatever the percentage is to meet my match? And then
it's calculated on a per year basis. So if you're putting, let's say they match 4% and they match 4% throughout the whole year. So they'll just take 4% of every paycheck. They're not going to take like all 4% in one. And then your HSA, you can only do HSA contributions, you can only elect HSA contributions once a year. So you choose how much you're going to do when you do open enrollment. So either when you joined your company or that one time a year, which is for most people in the fall. For some people, like whoever works at CVS, it's like April. So you choose that one time a year, and then they'll just take that out of your paycheck for the rest of the time. So when we say like max all these things out, you're choosing throughout the year, and it's gonna get divided throughout the whole year. It's just whenever it's able. Actually, let's talk about rollovers here a little bit. Does anybody know what a rollover is? Nope. All right, so a rollover is when you move assets from one account to another. So Carol, you had your old 401k at a company and you have a new 401k that you haven't started contributing to yet. You can do what's called a rollover, right? So when you have an old 401k, your options are you can leave it where it is if they let you. You can roll it to your new 401k, meaning you just take it from the old one and put it in the new one. Or you can roll it or you could cash it out, I guess. That's too stupid. Don't ever do that. You can cash it out.
We were just trying to roll it over before this call.
Or you could roll it to an IRA. So 401ks and all that stuff, those can all become IRAs. If they were traditional before, they'll be traditional now. If they're Roth before, they'll be Roth now. If you make Roth contributions, the company can't match a Roth because, again, you have to pay the taxes. So they'll make your matches into traditional, so there'll be like a split. But whenever you get to rollovers, the ideal solution is whichever is the most tax advantaged, right? So if you have a really good old plan and a super shitty new plan, like they pay a lot of fees, then we want to maybe leave it in the old plan. If we have a good plan, like the new plan is good, and newer plans should almost always be better than older plans. But if you go from like a great company, like you're working at Costco, and now you're going to go work at like Joe's Pharmacy is probably going to charge you a lot more for fees. So maybe we'll leave the money at Costco or roll it into an IRA. We don't want to roll it into an account that has more fees. Does that make sense? So a lot of you are going to deal with rollovers. Every time you change companies, they're going to ask you about a rollover, and those are the options they're going to give you. Some doofus is going to tell you to cash it out. Don't do that. You're going to pay taxes and a penalty. You're going to convince yourself that you could better utilize that money for something else. I have a car I could do. Remember that car is going to cost you an extra 10% than what you think it is because you're paying that penalty. So don't do that. Generally, you don't want to have a whole bunch of old 401ks all at separate institutions because it's just going to get confusing and you're going to get old and you're going to have Alzheimer's and you're going to forget where the money's at. So like keeping it all together is going to be better off. So if you can just keep rolling them into your new 401k, you're going to be better off. Does that make sense? Cool. I love not having a script. It's like the best thing. Questions? What else we got? Investments or retirement related? Go ahead.
I have a question. Okay, so for building your investment portfolio. I know that like you could go through YFP and have like a financial advisor kind of like help you with that. Or if you were wanting to do it yourself, could you just like go to Vanguard and
Oh, yeah.
start, you know, setting things up? Like, I guess, what are some good resources if you want to go that route?
Yeah, Google is a great resource for that. If you just Google Vanguard 3-fund portfolio, you're going to find the 3 funds that they want you to invest in. And it's basically going to be like the total U.S. market fund. So it's an ETF or an index that just has every company in the U.S. And then there's another index fund or ETF that has every company outside the U.S. And there's going to be another one that has every bond in the world, just kind of all together. And you're just investing in all that. So it's a 3-fund portfolio. You have 3 investments, and then you just contribute to that over and over again. That basically just says, please give me that average return, and I'll be fine. You don't need to work with an investment manager, right? At YFP, we do investments for people, but a lot of times I'll just send people to Vanguard, right? Because I don't need to do it for you. I just need to make sure you're doing it. I'm here to help you. I'm here to be your accountability and your educator and your follow through, right? So if you're at investments at Vanguard, cool. If you want to use Betterment or some of those online tools, I've used Betterment. I like Betterment. We may use Betterment at YFP at some point. So all those tools are good. If your investment advisor is charging you a bunch of money, that's generally not a good idea. But if they're giving you a bunch of other services, then maybe it can still be okay. I mean, YFP, we charge a ton of money, but we do a ton of services, so it makes sense. You just got to make sure that there's value there. So I would just kind of Google kind of what you want to do there. I honestly wish I knew this. I don't even know. We may have some resources on the YFP blogs about this. And if not, I'll send you over to White Coat Investor. White Coat Investor is another kind of forum, and they do a great job talking about Vanguard. They hate investment advisors, so they do a pretty good job though. But yeah, 3-fund portfolio is good for most people. Good question. Also, Allison, do you have another one?
No, I was just saying thanks.
Oh yeah. How big is my audience in your house?
Just 2.
Okay.
And a dog.
And a dog. Just wondering. I was secretly hoping that it's like growing every week because you're like, oh, this guy's amazing. You guys should all come listen.
I'll just throw secret parties and let all my core residents come over and listen to you teach.
Yeah, that's how valuable I am for a free service. All right. Anybody else? Questions? No. All right. Anything unrelated? Anything not about investments or retirement that we want to discuss? Oh, we got one. I hope this isn't private. It is private. Can I move it over there? Okay, you can't see that anymore. I was wondering what taxes. Okay, so this is a question about I'm starting my first job. What should I claim on my taxes? Should I claim 1 or 0? So the new tax form shouldn't say that. The old W-4 had that where you would claim how many elections you wanted to withhold. The new W-4 shouldn't say that at all. The new W-4 for anybody starting new jobs right now should effectively be you fill out the top and you sign the bottom, and the government just decides how much they're going to take out for you, and then you can do math later in the year to make sure it's correct. Does anybody filled out one of those recently? Can I get some head shakes? Is that kind of what it was? Kind of, no one is agreeing with me.
I filled one out a couple of months ago, and I did have to decide on like what to do as
How
far
many
as
elections?
yeah, but it was more just like would you want to do itemized deductions or just like standard deductions?
Yeah. So the form basically says if you're normal, like if you're just you're single, then it'll decide for you. It'll ask if you want to take out extra money that you can put in there, but the whole 1 versus 0 shouldn't be the case anymore. If it is, and I'll kind of like just answer your question. If it's 1 or 0, I used to claim 0. I claimed 0 because I didn't want to have to owe taxes. So basically I didn't want them to withhold very much at all. They would take out more money and I would get a tax refund. When we talk about taxes at some point, that'll kind of be what's the best formula there. But if you're just shooting fish, you're just shooting in the dark, I'd rather get a refund than have a bill. But hopefully that helps. Anybody else? Questions? Related, unrelated? No? All right. Does anybody have an idea of what they want to talk about next time we meet? And if I don't get an idea, I'm going to start giving you suggestions. So nothing. Okay. So a couple ideas here. We could talk about taxes, estate. We could talk about credit. We could talk about salary negotiation. We could talk about home purchase, real estate investing, birth of a child, education planning, financial independence, retire early. Anybody excited about any of those things? There we go, Emily.
I think taxes would be a good one because I think we're all going to have to start paying more taxes now that we're making monies.
Okay, that's a vote for taxes. So taxes is going to be mostly an overview. We'll just talk about how taxes work. But that's a pretty good one. I got a vote for credit in the chat. So credit would be a discussion on how the credit system works and then how to review your own credit and kind of see what that looks like.
Home purchase.
Salary
Home purchase.
negotiation.
Okay, I got 2 for credit. I got 1 for home purchase. I got 1 for taxes. This is the most efficient poll I've ever had.
I second home purchase.
Oh, we got 2 home purchases.
Third home purchase.
3 home purchases. 4 home purchases. Going once, going twice. Oh, I got a couple. We got some from the phones. Credit, please, credit cards, tax or credit, tax. Oh man. Okay, here's what we'll do. Let's do, we're gonna do credit first because credit is involved in home purchase anyway. So let's do credit first and then we'll do home purchase after that and then we'll follow that with taxes. So we're gonna preset our next 3 meetings and then we can still change it as we go. So we'll do credit. So what we're gonna do is we're gonna send out a list for everybody on how to run your credit report. You probably already did it earlier on when I asked you to. If you didn't, do it again. And we'll run our credit, we can review it. We'll talk about how to view your credit, how to review your report, how it works, how to improve your credit if it's bad, and how to know that my credit's okay, I don't really need to worry about it anymore. Once we're good with credit, then we can go to home purchase. Just like in life, if your credit is shit, you probably shouldn't buy a house anyway, because it's gonna be very expensive. So you wanna make sure you know your credit before you go to buy a house and someone tells you it's very expensive. But that's kind of where we're at. Any final questions, comments, or concerns? Nope. I believe our next meeting is August 31st. So the last day of August, and then we'll be about halfway through. Yep. Anybody else? Nope. All right. Well, luckily we didn't scare Allison away. Normally she tells us when we're done with the meeting. And that didn't happen today. So Allison, you're free to go.
It's late. I'm going to bed.
Go to bed.
Yeah.
Y'all have a nice night. If you have any questions, feel free to throw them in Mighty Network. We'll also make sure everybody's in Mighty Network. And then I'll see you next time.
Thank you.
Thank you.